The European listed sector has been shrinking relative to other global markets in the last 5 or 10 years, and I think it's absolutely critical that we stop that decline and we again make sure the real benefits of real estate are understood. I think one of the key challenges is ensuring that the generalist investors understand the benefits of real estate, understand that sustainable income stream, growing dividends, and the benefits that that will show in a low growth environment.
The European Federation for Retirement Provision represent national pension fund associations. So not individual funds, but national associations, and at the moment we have 22 members from 15 European Union member states and from outside the European Union as well. Our members cover more than 80 million people in Europe, and the assets under management in our members are around 3.5 trillion euros. Real estate definitely as an asset class has been an important part of a well-diversified pension fund portfolio for a long time. There is also great diversity in this. Many funds have not used real estate, they have not understood the possibilities and especially of the listed real estate. I think that there are many opportunities for pension funds going forward, and they should take a close look at real estate and listed real estate markets and see what benefits for the stability of income, for the correlations, for many issues that are really important for the risk-taking capabilities of pension funds.
We invest in real estate both by investing directly or by investing in listed property companies. And we see the investment through listed property companies as quite interesting for two reasons. The first one is that it allows us to access to more diversified portfolio on the one hand, and on the other hand, it allows us to set up some specific operations with the know-how and the expertise of the teams of the property companies. We bring our investment capacity, they bring their expertise.
For us, when we think about listed real estate compared to private options, it's a clear trade-off of liquidity versus volatility. And those liquidity and volatility questions are always the ones we deal with. For us, the liquidity, if you get the right exposures, can outweigh the disbenefits of the volatility. But for us, those are the main issues. Of course, our recent experience has been coloured by the fact that some of the private funds don't deliver the returns and the liquidity that investors are looking for, which I think makes the case for listed real estate arguably more compelling going forward.
We feel that investing through the listed real estate securities market is a very efficient way of gaining exposure to real estate, basically because of 3 reasons. The first one being the governance we get. These funds, because they're stock market listed, they are followed by the central banks, by financial markets authorities, by stock exchanges, and also by fellow investors and sell-side analysts, which ensures that there's a proper guidance on governance, which is important to us and our clients. Secondly, there's liquidity, which helps us to move our positions back and forth. And because real estate is a local and a cyclical business, there's real opportunities there in that liquidity. And thirdly, it's a cost-efficient way of investing in real estate.
Allianz is a major investor in real estate. As people know, we have more than 20 billion of assets around the world. But the decision to invest in real estate is really the second decision to a more major decision called asset allocation between stocks, bonds, and alternative assets. And over the past 10 years, major insurance companies, including Allianz, have been reducing their position in stocks. Therefore, today, if we don't invest into real estate stocks, it's mainly because we don't invest in stocks rather than we don't invest in real estate stocks. Putting that aside, I think what's important is the 3 criteria for which we could go back to stocks, which is transparency, liquidity, and somehow a reduced volatility over time.
A lot of research actually explains and shows that listed real estate is exactly the same as non-listed real estate or direct real estate. So it's all a full proxy for the asset class real estate. That's also why APG runs a fully integrated strategy of exposing both to listed and non-listed real estate. Obviously, listed has the benefits of higher liquidity, but we try to not differentiate between the two categories, and therefore we have a much wider universe from where we can select the best opportunities. And sometimes these opportunities are on the listed side, and sometimes better opportunities, better assets or better management teams are available on the non-listed side.
I think it's important that we think about promoting the industry both at the individual company level and the sector level going forwards, and really think about that as a project. There's no doubt that the business model has changed at many companies. In many ways, European REITs have grown up in the last 5 years. We now are much more focused on revenue, cost control and dividend growth, and I think that is a message that needs to be clarified and consistently given to investors. I think that in itself will promote the sector far more positively.
The FTSE and EPRA organised seminars around the world attract very big audiences, and it ranges from REIT companies who want to learn more about how they can be included in the REIT indices. It includes the major investors from around the world who are thinking of either increasing their investment in property or are looking to use REITs for the first time. These are essential in building more and more interest in REIT investing.
The EPRA Research Group is currently working on a study which is examining the approach of investors and managers towards the listed sector in combination with the unlisted market and the private market. And it's trying to understand why it is that some investors use listed securities in their property portfolios and some investors don't. And I don't think it's a simple matter of selling the story about REIT diversification, REIT performance, listed company performance. I think we need to understand a bit more about the decision-making structures in those organisations. And we're finding that some organisations are very keen to use listed stocks in their property allocation, but for a set of historical reasons, they don't have a listed desk. And we find that others are starting to use listed and unlisted together, but are struggling to work out how to run the process alongside. So we're getting some interesting results from a different set of organisations. The headline tends to be that investors want to use listed and managers find it difficult to use listed and unlisted in the same portfolio.
The terms of the EPRA survey that we're undertaking at the moment, and we're just about halfway through the initial pilot study, are to look at how people look at listed real estate. Do they look at it as part of the real estate allocation, or is it just part of the overall equity allocation? And so far, I have to say that the results have been surprisingly good, to the extent that people do tend to look at REITs as part of the overall real estate allocation. However, one of the main issues they do have are the volatility, the benefits of liquidity, but they are concerned about the volatility. So the answers are slightly surprising in certain elements, but overall we're very pleased indeed at the way that people are looking at REITs as part of the overall real estate allocation.